Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths behind big corporate filings. Today we're diving into the semi-annual report for Twin Oaks ETFs, and let me tell you, some of the investment strategies here are quite active, if that sounds intriguing. And you want to understand what is really going on under the hood of these investment funds, make sure you are subscribed. And for more in-depth discussions and a community of like-minded financial sleuths, join our Discord server linked in the description below. We're essentially looking at how-to funds. The Twin Oak Active Opportunities ETF and the Twin Oak Short Horizon Absolute Return ETF have been performing. Think of these as two different approaches to managing money, and we've got the official report card right here. This report covers the 6 months leading up to the 30th of November 2025. It is a snapshot of their investments, their costs, and how they're performing. First up, the Twin Oak Active Opportunities ETF. This fund is aiming for long-term growth. Let's see if it is delivering. For a hypothetical $10,000 investment in the Active Opportunities ETF, the cost for these 6 months were just $19. That is a pretty small slice of the pie, representing 0.35% to be exact. This sounds good when you are talking about costs, they are relatively low. Now for the big numbers, as of the 30th of November 2025, this fund managed a massive $253 million in assets. That is a lot of money to keep track of. Interestingly, despite managing all that cash, they only held 3 things. That is a very concentrated approach. The fees paid to the advisors for managing this fund amounted to over $423,000, and the portfolio turnover rate was 0%. This means they were not actively buying and selling within the fund during this period. They essentially bought it and held it. So what were these 3 things they held? Almost all of it, 99.9%, was in other exchange-traded funds or ETFs. They are essentially investing in other funds. The biggest chunk, a whopping 74.7%, was in the Vanguard S&P 500 ETF. That is a very popular ETF that tracks the performance of the largest 500 companies in the US. Then 16.2% was in the iShares Ultra Short Duration Bond Active ETF. Think of this as a very conservative bond fund. And finally, 9% was in the JP Morgan Ultra Short Income ETF, another very safe short-term income focused fund. So this Active Opportunities Fund is really just a blend of a major stock market ETF and 2 very low risk bond ETFs. It is active in its strategy of combining these, but not active in daily trading. Now, let's switch gears to the other fund. This is the Twin Oak Short Horizon Absolute Return ETF. Its goal is to grow capital while keeping volatility low. For a similar $10,000 investment here, the costs were even lower at just $13 for the 6-month period. That is 0.25% even better cost-wise. This fund is smaller, managing around $45 million in net assets, and it held just 2 things, even more concentrated than the first fund. The advisory fees here were much lower, around $51,000, and just like the other fund, the portfolio turnover rate was 0%. Again, buy and hold. So what were these 2 holdings? This is where it gets really interesting. Let's look at the top holdings. Around 66.5% was in SPDR S&P 500 ETF Trust Call Options, and 33.4% was in SPDR S&P 500 ETF Trust. Put options, they are heavily invested in options related to the SPDR S&P 500 ETF Trust, which itself tracks the S&P 500. This strategy is a little like playing both sides of a coin. They've bought call options, which bet on the S&P 500 going up, and put options, which bet on it going down. This is an absolute return strategy aiming to make money whether the market goes up or down. It is quite a complex way to invest. And interesting to note here is the credit breakdown. Essentially, 99.9% is rated AA by S&P Global. This indicates a high level of credit quality. Remember, the explanation for this rating refers to flex options, which are customizable exchange-traded options. Looking at the actual financial statements, we can see the details. For the Active Opportunities ETF, the schedule of investments confirms that nearly all its assets, 99.9%, are in exchange-traded funds. The Vanguard S&P 500 ETF alone makes up a huge chunk of this fund. The statements of assets and liabilities show the net assets for the Active Opportunities ETF at over $253 million, with a net asset value per S-share of $28.17. For the Short Horizon ETF, net assets are around $45 million, with a net asset value per S-share of $28.28. When we look at the statements of operations, which show how the funds made or lost money, the Active Opportunities ETF had a significant net investment income with over $2 million in dividends and interest. It also saw a substantial unrealized gain of nearly $26.2 million. This reflects the growth in the value of its holdings. The statements of changes in net assets show a big increase in net assets for the Active Opportunities ETF, over $28 million from operations alone. The financial highlights give us a per S-Hair view. For the Active Opportunities ETF, the total return for the period was a solid 12.56%. And importantly, the expense ratio after fees were waived came in at a very low 0.35%. This is a crucial number for investors. Now, for the short horizon ETF's operations, it had a net investment loss of about $49,000. However, it booked a net realized gain of over $859,000 from its options trading and a small unrealized gain. Its expense ratio after fees were waived was even lower at 0.25%. This is incredibly efficient for any fund, let alone one using complex derivatives like options. Scrollwatt is my take on all this. The Twin Oak Active Opportunities ETF seems to be taking a very straightforward approach. It is essentially a bet on the S&P 500 combined with some very conservative bond ETFs. It is not exactly going out on a limb, but for investors looking for broad market exposure with minimal trading and low costs, it's simple and effective. The actively managed part seems to be more about the blend of asset classes rather than active trading. When it comes to the Twin Oak Short Horizon Absolute Return ETF, this is where the strategy gets more sophisticated. Using options to aim for returns in both up and down markets is a high reward approach. The fact that the portfolio turnover is 0% despite using options suggests they are holding these options for a period, likely to capture broader market movements rather than short-term fluctuations. The very low expense ratio is impressive, especially given the complexity of its strategy. However, relying so heavily on options for returns carries inherent risks that investors need to be very aware of. Even with the defined risk options, large market swings can still lead to significant losses. Overall, Twin Oak seems to be offering distinct strategies. One is very traditional and low cost, while the other is more complex and aims for absolute returns. The low expense ratios across the board are a definite positive, and investors should appreciate the transparency in their reporting. However, the complexity of the short horizon ETF strategy means investors need to do their homework and truly understand what they are investing in. Alright, that is our breakdown of these Twin Oak ETF reports. What is your take on these investment strategies? Are you a fan of the simple S&P 500 approach, or do you find the options strategy intriguing? Drop your thoughts in the comments below. If this deep dive was valuable, please hit that like button and subscribe for more corporate decoding. And don't forget to join our Discord community for more discussions like this. Thanks for watching, and I'll see you next time.